So we are going to start our next session. I hope all of you can hear me quite properly, quite easily. In today's session, we will do two questions relevant with the net present value, and the other one is relevant with another topic of specific investment decisions. So we are starting from this question. It is March, June 2023. G Company is a listed company that manufactures innovative product for the telecommunication industry. G Company has just developed a new product called LP500, which is expected to have a projected life of 4 years. So I hope up till now you guys knows that net present value focuses on what? Net present value focuses on the new or long-term projects where we are going to launch a new product for certain number of years, like 4 years, 5 years, or more. Or similarly, we are going to start a new project which will last for a number of years. So that is why this investment appraisal or capital budgeting is called long-term budgeting. Is called the for 4 years life. Then is saying that G company's management has decided that the sales price for LP500 will be $90 per unit. So the selling price is what is $90 per unit. As anything higher than this will dramatically reduce the expected annual sales volume, which is currently forecast to 20,000 per unit. So their for sales forecast is 20,000 per unit forecast, that we are expected to sell 20,000 units each year. Variable cost of LP includes the cost of bought-in computer. Bought-in computer means specifically incurred cost. The X22, the price of the X22 has been volatile due to supply problems with the manufacturers, and consequently variable cost per unit is at present uncertain. The management of the G company has made the following estimate of variable cost per unit along with its associated probability. So we are provided with four different variable costs, and we have four different probabilities. But you can add up all these probabilities, and probabilities can never exceed 100%. Incremental fixed cost is 300,000 per year. All of the above figures are expressed in current price terms. Current price terms means these figures are provided in year zero terms. So if we are provided with the inflation in the question, inflation is applicable from year one. Sales price inflation is expected to be 5% per year. Variable cost per unit and fixed cost inflation are both expected to be 3% per year. New plant and equipment costing 1.5 million, which means capital expenditure which is incurred in year zero, will need to be purchased at the start of the first year of operation and is expected to have a residual value of 125,000 in nominal terms. Nominal terms means inflation is already included in this 125,000. So there is no need to add further inflation in this amount. At the end of year 4, GINI company pays corporation tax rate at 20%, and tax is payable at the end of each year. So tax for the year 1 is payable at the end of year 1, then so on. And but usually we are provided with the in the question that tax is payable in 1 year in areas, which means tax for the year 1 is paid in year 2. For year 2 we will pay in year 3, and so on. Then we have what the company can claim tax allowable depreciation at a rate of 25% per year on reducing balance basis with a balancing adjustment in the year of disposal. Additional working capital totaling 100,000 will also be required at the start of the project. So we will invest in working capital at the start of the project, means in year zero, and working capital is invested on incremental basis. So further, he is saying that working capital inflation is 3% per year. It is invested on incremental basis, but in the last year, the whole working capital uh, uh, will be recovered in the will be recovered in the last year of the project. G company's nominal after tax cost of capital is 12% per year. So a weighted average cost of capital means discount rate which we use to calculate the net present value. Further, he is saying calculate the expected NPV of LP500 project and comment on its financial acceptability. So first of all, we will solve this part A. Part A contains 12 marks and basically it is the one which is focusing on the calculation of net present value. So learn the steps of net present value, that how do we calculate NPV. We are provided here with the information of variable cost which has different probabilities. So here first of all we will calculate expected value of variable cost per unit is equal to 40 into 0.2 plus $50 multiplied by zero point 0.4 plus 60 into zero point 0.2 plus 70 into zero point 0.2. So we have what $54 as an expected value of what expected value of variable cost. Now we will prepare our net present value table. Years 0, 1, 2, 3, 4. If we are provided with the information in the question that tax is payable 1 year in arrears, then we need to add one additional year like year 5. But here we are paying tax at the end of each year, so we have only 4 years. Now it is started from initial investment.
Hello, sir.
Whenever you are attempting,
Hello, sir.
so in question, he says that tax is 20% and payable at the end of each year following the year to which it relates, which means 1 year in arrears. So we have one additional year. It is started from initial investment. Always follow this sequence. Initial investment is what? $1.5 million. This one is $1.5 million. We usually follow hundred thousands. So it means now rather 1.5 million, we will say it is 1500. Negative means what? It is a cash outflow because we are going to make investment or we are going to incur cost. Basically, there is a cash outflow. And in net present value focuses on what? Net present value focuses on cash inflows and outflows. Now we will calculate sales revenue is equal to, we are provided with the information that there are 20,000 units per year demand, constant demand. Now we are using data in hundred thousands. So that's why I will not write full 20,000. I will only use 20 multiplied by selling price 90. And further, he was saying that all the above figures are given in current price terms, which mean in year zero terms. So sales price inflation is 5%, applicable from year 1, 1.05, raised to power year 1. So for year 1, we have sales revenue of 1890. Now what can I do? I will use this formula, copy and paste in the next three accounting years. And in next 3 years, there is no change in the sales quantity. There is no change in the selling price. I only need to change the year. So here we have 1984.5. Then in the third year, it is 2083. Then we have the last year where we have 2187. So this is the way to determine sales revenue. Then we have what? We have variable cost. Less variable cost. So again, units are same. Multiply by this expected value of variable cost 54. I am not giving cell reference, writing 54. And here we have variable cost inflation of 3% per year. So 1.03 raised to power year 1. I can use minus sign over here to show that I am deducting, or if I do not use, there is no issue, but ultimately this value is deducted. And I have mentioned that less variable cost. Now I will use copy and paste, and I will just change the number of years from raised to power because units and variable costs are same. Then we have the fixed cost. What is fixed cost? Incremental cost is 300,000 per year, and same 3% inflation is applicable, is equal to 300 into 1.03 raised to power 1. Once again, there will be only change in year. So this is fixed cost. We don't have any other cost. So sales less what? Variable and fixed cost. And now we will calculate what? We will calculate before tax cash flows is equal to this minus this minus this minus this, and the next one, this one. So we have before tax cash flows. So we have before tax cash flows for each one of the year. Now remember this sequence starting from initial investment and showing in year 0, then sales revenue, then variable cost, and then incremental fixed cost. If general fixed overheads are provided in the question, we will not consider general fixed overheads as the relevant cost. Now it is before tax, so what will we do? We will deduct tax. How much? Tax is given here 20%. So 20% is equal to this multiplied by 0.2, which means 20%, 1 year in arrears. Then we have this tax multiplied by 20%, then tax at year 3, but payable in year 4. And lastly, this is taxation. So now we will deduct what? Tax. And here we have after tax cash flows. negative 1500, 468.6 before tax minus after tax, and we will copy and paste this formula in next 2 years. And in the last accounting period, there is only one thing, which is tax payment of 126.94. So here we have after tax cash flows. Whenever we are provided with the information of working capital, we will deduct working capital from after tax. So we have working capital of 100,000 in year zero. Then it will grow by 3% of inflation raised to power 1. But remember, working capital is invested only on incremental basis. So incremental basis means what? Incremental basis means we will deduct the investment already incurred. It means what? Now working capital is showing 100, but we will deduct previous or already invested working capital of 100 in year 0. And this will continue for the next 3 years, where we will invest in working capital only on incremental basis. So incremental basis are inflation. So that's why I am just changing the raised to power number of years. So here we have the working capital. What is the working capital? Working capital is 100 in year 0. Then on the incremental basis, it is invested, up till 3 year 3, we will make investment. And working capital will be recovered in the last year of the project. So initial investment was 100, then incremental was 3, then incremental was 6.09, and then incremental is 9.27. So what will we do? We will add up this working capital which we invested from year 0 up till year 3, and in the last year the whole working capital is recovered. So now what will we do? We will calculate before present values cash flows. Before present value cash flows. So in year 0 we have what? 1600. Here this plus this. So now we will calculate after tax cash flows, before present values cash flows. For each year, and same is the way to determine, but in next year it is positive, so value is rising, and the last value is tax payment. It is 126.94, and remember it's a tax payment. Lastly, we will deduct this value. Now we will calculate present value at 12%. We are provided with the present value table in the question, but remember one thing, for year 0, present value factor or annuity factor is always when. But otherwise, we are provided with the present value factors in the present value table, and which is given in your exam kit, and it will be provided by the examiner in the actual exams. But otherwise, you can also use the formula of present value where cash flow is divided by 1 plus discount rate, which is 12% or cost of capital, raised to power year 1, raised to power year 1. So it is 415.75. We will follow the same formula, but here we need to change raised to power years, year 2. Now I did not use present value table, but I can calculate present values by using this formula, which is also provided in your study text, and similarly at the top of present value table, where cash flow is divided by 1 plus discount rate raised to power number of years. So this whole is what? This one is the present value at 12%. And for us, these present values are basically relevant. So here what will we do? We will sum up all these present values. Present value of cash flows is equal to, we are going to add up all these values. I did not added up the last year's value over here because in fact it is the negative value. So we need to deduct this value. So present value of cash flows is what? Present value of cash flows is negative 114, and we need to make the adjustment of the last year. I don't think so. Okay. So the adjustment of the last year is 72. One thing we will add over here separately, or we can add in the table as well. I am adding here separately present value of scrap or residual value, which is provided here 125,000. So rather than using the word of scrap, I will say present value of residual value. It will arise when it will arise at the end of year 4 and already given in nominal terms, which means there will be no use of inflation in scrap value. So we will simply calculate what? We will simply calculate present value 1.12 raised to power year 4. So we will make adjustment in our this present value of cash flows, and we will add this value of 79.44 approximately. So our present value of cash flows is effectively what it is, 107.04 negative. We have initial investment of 1600, and these one are what? These are the present values. Next, we need to do what? Now we need to make a present value of tax saving on capital loans. So here we have a table that the tax depreciation, allowable depreciation is 25% per year. So look at this table. Present value of tax saving in capital allowance. Tax saving on capital loans. So we are going to make table years, written down value, then we have capital allowance, %25, tax saving 30%. Sorry, tax rate is 20%. Then we have present value at 12%. We are paying tax 1 year in arrears. We started tax payment from year two. That is why tax saving will also start from year two. Written down value means what? Written down value means your initial investment. And initial investment is given in what? It is given in million, but we are representing our values in hundred thousands. So it is starting from where? 1.5 million. Capital allowance is what? It is 25% of this written down value. Tax saving is what? Tax saving is 20% on capital allowance, and present value is what? So it is 59.79. Written down value in the next year, preceding year minus capital allowance, it is the written down value of the next year. Now what will we do? We will take 25%, then we will take 20%, and now what will we do? We will say tax saving divided by 1.12 raised to power 3. Otherwise, we can use present value factors as well from the table. So in next year, this minus this, then we have capital allowance, and then we have tax saving on capital allowance. And lastly, we have what? This divided by 1.12 raised to power 4. In the last year, written down value minus capital allowance, it is 632.82. Less what? Less residual value. Now look at the last year working quite carefully. Now we will do what? We will deduct residual value first from this value. And residual value is 125,000. So I am saying that in the last year, my net book value is 632.82. And I am selling my equipment for just 125,000. It means I am selling in loss, and the whole loss will become what? It will become balancing allowance for me, the whole loss. So for the last year, don't forget this working, or don't forget this table. This is the way to solve the last year. And the whole balancing allowance will become capital allowance in the last year. And now we will do what? We will calculate tax savings. So this is the present value. Now what will we do? We will add up all these present values. In your study text, they makes a column of figures, written down value, capital allowance, and tax saving. They do not calculate present value over here. They make the part of present value of this main table. But I usually prefer to make one additional column and calculate your present value of tax saving at 12% separately. So now we will do what? We will calculate the net present value here. Net present value is equal to present value of cash flows plus present value of tax saving on capital allowance. So the net present value is what? Net present value is positive. Positive net present value means profit or gain. So question was saying comment on its financial viability. So if net present value is positive, it means project is financially viable. Project is financially viable and we should make investment in it. So this was the answer of this net present value. Any question? So we are done with the part A. Now we will do part B1, which is asking that how it will help us achieving the primary objective. GINI is a listed company, which means profit-seeking organization. In part A, net present value is positive. So this project is financially viable for GINI and it will help to maximize profit. Next part is discuss the three limitations of using probability analysis in deciding whether or not to proceed with LP 500. So here we used what? We used probabilities. Probabilities to do what? Probabilities to determine the expected value of variable cost. So now he is saying that what are the limitations of probabilities or how limitations of probabilities can affect the decision, because probabilities are what? Probabilities are subjective things. So first one is probabilities are subjective. Here we are using four different variable costs and their respective probabilities which says that expected value of variable cost will be 54, but actual cost can differ because company is expecting variable cost could be $60 or $70. So the first thing is probabilities are subjective. Number two, probabilities are based on possible outcomes possible outcomes. Usually there are three possible outcomes: best, most likely, and worst. But here we have four possible outcomes. One is 40% and rest are same. But again, actual cost can differ significantly from possible outcomes. Then what else could be the limitation of probability? Probability can lead us to incorrect results, incorrect decisions if actual cost is not close to expected value of $54. So in this scenario, we took the reference of variable cost, but in other scenarios, it could be selling price, it could be sales demand, but we need to consider this fact that probabilities are subjective, probabilities are based on the possible outcomes, probabilities are the one which can lead us to the incorrect results, because here we are using possible outcomes and possible outcomes can differ significantly. Right, everyone? Any question?